Hey, I'm Kaitlin, I'm a CPA, and I have had a lot of people who run a business by themselves ask me if they should be a sole proprietor or if they should incorporate. So I want to talk a little bit about what the difference is, how it might impact you as a business owner, and what you want to think about if you want to make the jump from sole proprietor to corporation. So the first one I want to talk to you about is a sole proprietor. That's the simplest form of business. It's an individual that just starts doing business. There's no setup costs or any of that, no legal hoops that you have to jump through. You will need a business license from the municipality, and you might need specific licenses depending on the industry that you're in. But generally speaking, it's just an individual that starts conducting business. With a corporation, you're setting up a whole separate legal entity. So you've got to file with the government issues some paper in return. There's a few other little legal hoops that you have to jump through, which you might need a lawyer for, so that's going to incur some more fees. Generally speaking, it's a much more complicated organization structure than a sole proprietor, so it's important that you're going to reap some benefits from going through all that. Another important thing to keep in mind is liability. The liability of a sole proprietor is unlimited. If you have debts that you can't pay, those debtors can go after your personal assets, not just the assets of the business. Because when we talk about the business of a sole proprietor, we're really talking about just the individual. One of the main benefits of a corporation is that it is a separate legal entity. So any debtors of the corporation cannot go after your personal assets. They're separate from the business. Just so we're clear, when I am talking about liability, I am talking specifically about financial liability. Generally speaking, the negligence is the liability of a corporation, but there's been lots of examples where a judge has ruled that the CEO has been personally responsible, so that becomes a lot more gray than the financial piece. When you're starting a business, you need money. As a sole proprietor, you're limited to whatever you have in the bank, whatever you can sell, or whatever you can draw upon in terms of credit on your own, or whatever you can borrow from your friends. A corporation can generate money in two ways. The first is to borrow, just like an individual. The corporation itself will borrow the money from the bank, which means the corporation itself is responsible for paying that money back. Now, the bank likes to limit its risk. So as the owner of the company, you're likely going to have to put a personal guarantee on anything that the corporation borrows, which totally nullifies the limited liability. The second way that a corporation can generate money is by getting people to invest. If you convince somebody that your business is a great idea, they will give you money, and it seems like it's free, but it's not exactly. So if somebody invests in your company, they're going to want something back. Generally, that means dividends, or maybe they want a little piece of control. At the very least, you have somebody else that you're accountable to, so that might not be something that you're willing to give up in order for a little bit of startup money. One of the biggest differences between a sole proprietor and a corporation is taxes. A sole proprietor is an individual, which means any profits or losses go on the individual's tax return. If the individual has income from other sources besides the business, that could mean that the business income will be taxed at a much higher rate. Because a corporation is a separate legal entity, they pay their own taxes. It's a lot more complicated than an individual's taxes, so you're going to need somebody to help you. It opens up a whole new toolkit in terms of strategies so that you can pay less in tax at the end of the day. The last thing I want to talk about is transferability. As a sole proprietor, the business is you. So there's nothing to sell to somebody else. You could certainly sell the assets in the company, but you can't sell the business itself. With a corporation, you own shares in that company, which means you can sell those shares and the buyer becomes the owner of that company. You can also leave the shares in your will to your kids as part of estate planning. So when somebody asks me, I'm just starting my business, should I be a sole proprietor or a corporation? I tell them generally to start out as a sole proprietor. Started your business because you love doing whatever it is that you're doing. And you don't want to spend your time maintaining the structure of the organization. So a sole proprietor, because of the simplicity, allows you to spend more time doing what you love doing. A corporation is good for when the company gets to be at such a size that you're making a bunch of money, you want to be able to protect yourself, and you want to pay less in taxes. Until that point, it's really not worth it. You can spend more time doing what you love doing as a sole proprietor, and less time on the administrative stuff. Thanks for watching. I'm hoping to do a series of these videos answering your questions about accounting and taxes. So if you have a question, please email me, Kaitlin@kirkcpa.ca, or you can comment below. Bye! When you start a company, you'll need money to do it. If you have somebody invest in your company, generally they're going to want some kind of a return on their money. So they're going to either, as a sole proprietor, when you're starting your business, the first piece of money, one of the main reasons that somebody would start a corporation is the taxation benefits.
Need an air horn.
Honk! Brap, brap. So when somebody asks me,